Nicholas Bornolis of Capital Link. I would like to welcome you to the ETF Roundtable. I'd like to thank the New York Stock Exchange for their partnership over the years and for helping us to put this event together. And every year, among others, they're also putting together this great panel. So I will turn it over to Doug Yones, who is in charge of exchange-traded products of the New York Stock Exchange. Thank him for putting this great panel together, and he will introduce the panelists. And Doug, the floor is yours, and thank you again.
Thank you so much, Nicholas. Good to see your face. I look forward to the 21st annual when we can be back together. But welcome to the ETF Industry Roundtable. This is the 20th annual Capital Links Closed-End Funds and Global ETFs Forum. I'm excited to be here. For anyone I don't know, my name is Douglas Yones. I head up the Exchange Traded Products Group at the New York Stock Exchange. I am really excited to be moderating today's panel. Thank you all for joining us. Here with not just three friends, but three industry veterans of the ETF marketplace. So I'm going to quickly introduce them, but of course you could go through the website and take a look through profiles. We have Gunjan Chauhan. She is the global head of Spider Capital Markets for State Street Global Advisors. Paul Kim is the CEO and co-founder of Simplify ETFs. And Arne Noack is the head of Systematic Investment Solutions for DWS. Team, thank you so much for being here to share your thoughts. I want to kick right off. Gunjan, State Street has been there since literally the beginning of the ETF marketplace, launching the very first US listed ETF with SPY. Certainly over the years, we have seen the usage of ETFs change quite dramatically. First trading vehicles, investment vehicles. I'm curious from State Street's point of view, talk to us about the various use cases for ETFs today. How's that changing? Is it changing going into the future? You know, what does the landscape look like?
Yeah, Doug, thanks for the question. And look, it's lovely to be here with everybody. So thank you so much for having me part of today's session. Really appreciate it. I think you're right. You know, the world of ETF trading has changed dramatically. And I think some of that change has certainly been accelerated by the events that we saw of March last year through the height of COVID volatility. But fundamentally, the use cases of ETFs, at least from what we've seen, they've expanded. You know, you've got the use cases that are still very much there front and center, whether it's cash equitization to really minimize cash drag on portfolios, whether it's for liquidity management and making sure that ETFs now play more of a core role in the liquidity sleeve for portfolio managers, or whether it's really supporting asset allocation, tactical or strategic. All of those use cases are very much still there. What we've really seen is the expansion of those use cases. So what's really coming to the forefront now, alongside some of the more traditional hedging or transition management use cases, is ETFs being used as a price discovery tool, as we saw through the height of COVID, for traditional fixed income investors. ETFs, with the transparency that they are actually offering the traditional fixed income investors, have really widened the use cases for that subset and that core group. That's also allowed a number of new entrants to also come into the marketplace. Perhaps some traditional fixed income investors that were used to trading single name bonds are really now drawn to the efficiencies of trading hundreds and sometimes thousands of CUSIPs at a click of a button through the ETF wrapper, and the efficiencies that trading mechanism in and of itself, alongside the transparency, actually offers the traditional OTC markets. So I think we've seen the use cases expand, and also the entrance into the ETF trading world also expand.
Thanks for that. And Paul, you know, you've been in this market for a while. We've known each other many years. You've been in a number of different places, but now you, as the founder here of Simplify, you are absolutely taking on what we'll maybe call the institutional investment use cases of ETFs. Can you explain how you thought about that space and to the audience what you've been working on?
Sure, and thanks, Doug, and thank you everyone for this opportunity. We're a relatively new ETF firm. We're staffed by a large number of extremely experienced veterans from the largest institutional asset managers, multi-billion-dollar hedge funds and family offices and RIAs. And I think ETFs continue to be a really, really interesting tool for the smallest and the largest, increasingly, investors. And I think the use case in the institutional space is really, really tied to the current investment horizon and environment for everyone, right? So it's a universal struggle. What are the three main struggles that we're seeing? One, stretch valuations across all assets, and obviously fear of sort of drawdowns and things like that. Two, reaching for yield in a very low yield and often negative yielding world. And three, how to find diversification when bonds, because they are at such low yields, are increasingly correlated with risk assets. And I think one institutional use case made possible recently through continued adoption of derivatives inside of ETFs, and recently in October of 2020, the passing of the derivatives rule, which provides flexibility for all 40 Act funds, including ETFs and RICs actually, to make greater use of derivatives. It's opened up the playbook, if you will, to use things like options, which are great complements to bonds, right? Bonds and other sort of strategies like low vol or factor investing are often correlation-based hedges, i.e. things that generally zig when equities and risk assets zag. But I think when you complement those correlation-based hedges with direct hedges, including options, it gives professional asset allocators a little bit more of a toolkit in terms of protecting downside, right? For, again, the stretch valuation concerns, generating income and yield when you have such low yields everywhere. And then finally, guaranteeing diversification, unlike the correlation-based hedges, which often flip in correlations. Finally, I think ETFs, just a general trend, ETFs remain the investor vehicle of choice. Even the largest institutions, and again, including the pensions and endowments of the world, find ETFs to be very convenient, very cost effective, and are increasingly a part of their portfolio.
Yeah, thank you for that. And you know, it is so interesting over the years to watch more and more complex structures come into the ETF wrapper. I mean, in the beginning, the early days, we always talked about ETFs as just mutual funds with this wrapper so that they could list on an exchange. And that's really what they've become, is, you know, a mutual fund like structure where you have a lot of different and unique benefits within a single wrapper. Arne, I want to come to you and talk a little bit about DWS, right? You've got this very large global footprint. You personally are speaking to clients all around the world. I'm wondering how those conversations have maybe changed from the clients that are using your ETFs. Are they using them differently in the past, you know, or now versus how they have in the past?
Yeah. First of all, Doug, let me add my thanks and appreciation to those of the previous speakers for having me on this panel. I would certainly agree with Gunjan in terms of the observations, especially when it comes to institutional usage. What we're seeing is very much that there is an evolution of use cases that is very distinct and specific to the different client segments that we service. So for example, when we speak about insurance companies here in the US, there is very much a renewed and increasing desire to find out how ETFs can be useful for the purpose of the special accounts, of the general accounts, and see what we can do in partnership with those insurance clients. And in particular, when we look at our fixed income ETF range, in particular high yield fixed income, we have a couple of very clear use cases for insurance clients here. Separate to that, we have, let's say, a certain evolution in the more wealth management or wealth facing, retail facing space. And the form it takes here is a lot of our financial advisors engage in conversation around ESG, so environmental, social, and governance related aspects, and want to find out how they can utilize ETFs for the purpose of either accomplishing certain value-based portfolios or a generic improvement across all those factors. And what really helps us here, and Doug, you alluded to that already, is our global footprint, because of course, you know, whilst ESG investing is very much a global phenomenon, there are very meaningful regional specificities and differentiated developments. Broadly speaking, you know, European regulation and in particular regulation as it pertains to the wealth management space has been tightening significantly when it comes to ESG. We have not seen the same development here in the US, but certainly the SEC has a very clear eye on anything that pertains to ESG. It is generally in mainstream newspapers, you know, in various forms. So for us to have a strong foundation in Europe, we seek to import a lot of our knowledge here for the benefit of our US-based clients and help them find efficient solutions that, in an ideal world, of course, is being implemented utilizing our ETFs, and that's very possible, but doesn't necessarily need to be limited to that ETF conversation. So back to your question, I would say the evolution is really dependent on the different client segments that we serve.
You know, you bring up this topic of ESG and such a great it's happened both in as well as investors thinking about and that particular you're getting.
Doug, I'm afraid we lost you. I think I caught some parts of that, but just wanted to check in if you're back. Oh, no, we lost him completely. I did catch some of Doug's question, and I think what he was trying to ask was in relation to ESG investing. So I'll just pick up on here as it sort of also alludes to or connects to the previous point that I made. When we look at the US ETF market in particular, one of the fastest growing segment is environmental, social, and governance related investing. Billions of dollars have poured into that segment over the past, I would say, year and a half, and in particular, the pandemic has been a boon for ESG-based strategies. What I would say, and what of course we are encouraging people to have, is that there is very much different segments or different colors of ESG, so to speak. So as I already mentioned, the topic of ESG pertains to environmental, social, and governance related aspects. And Doug, welcome back. I was trying to essentially infer from what I did here, so that maybe you want to repeat the question so our audience can follow up.
Yeah, so sorry about that. I'm not sure what's happening, but I just asked you to kick off the conversation around ESG investing. And, you know, we say ESG and it comes up in so many headlines, but how should investors think about that space as an investment?
Great. So I was rightfully intuiting what you were trying to point to in your question, so I appreciate the clarification. So essentially following on to that, a couple of points to make. Of course, E stands for environment, so S stands for social, G for governance. So just from looking at those three terms, you can also already see that the term ESG covers a broad swath of possible topics. So you as an investor should always be clear that, you know, no broad ESG strategy is likely to be like any other. So really understand what is it that both, you know, is it that you're looking at, as well as does it fit with your own desires? Or for example, instead of wanting to have a broad look at all ESG related aspects, you as the investor decide, hey, I agree social and governance related aspects are important, but for the purpose of this specific portfolio allocation, I really want to consider environmental aspects. And therefore I really only care about the E part and what all falls under the E part. So I would say, generally speaking, ESG-based investment is best served by slowing down, by understanding what is covered by ESG, understand exactly, does that align to my own personal objectives and values, and see if I can engage with either a wealth manager or an asset manager in a conversation to hone exactly how can I best fit my needs with existing investment vehicles. And that's really what we want to be here for clients to, instead of finding ready-made boxes to sell, really engage in conversation that are tailor-made and find solutions for the purpose of very specific challenges and problems.
Thanks for that. And again, apologies for my disconnection there. Gunjan, I want to come to you. This topic is just so big. And I've seen, SSGA has put out research. How are you and your teams discussing this topic? How are you defining ESG as an investment category?
Yeah, Doug, it is a massive topic, so I do think it does warrant the time and attention on the subject. You heard from Arne, how some of the definitions are being interpreted across different organizations, and the conversations that we're all having with clients to really help educate them in the space. I think the definition of ESG investing is a complicated one. It can be really as simple or as complicated depending upon who's defining exactly what it is. And I think you almost need to take a step back and understand who's providing the definition and in what context. And what I mean by that is, if you take a look at the definition from the Forum of Sustainable and Responsible Investments, they actually align with the UN Principles of Responsible Investments, and their definition would very specifically be that ESG investing is defined as the practice of incorporating environmental, social, and governance factors in investment decisions and active ownership. So there's a lot that could be interpreted from that specific definition alone. At SSGA, we further extend that definition to specify that ESG investing is an assessment of material, environmental, social, and governance issues during the investment process. Materiality can actually be defined from State Street Global Advisors' perspective as the relevance of a particular ESG measure to a company or a sector. And that's something we've spent a considerable amount of time investing in, understanding, and then just ensuring that we've got the right data to really get under the hood and into the weeds on some of those specifics. I think it's also worth pointing out that the key point for our team is that we focus on the financially material ESG metrics, as we believe that we have a responsibility to systematically and explicitly include material ESG metrics in the traditional investment analysis and decision-making process. And I think that's where you've seen much of the industry now move towards. We've stepped up from the generation 1 products, and you're now seeing, with the proliferation of data, more sophistication in the process.
Thank you. And Paul, I want to come to you, and I don't want to get you in trouble, compliance, because you're in kind of pre-launch stage, I'll call it, but I'll let you discuss what you're allowed to discuss about personal product plans, but certainly you're no stranger in the world of ESG. You're working in that space. Could you share with us some of your thoughts?
Sure. I think the term complicated was used, right, to describe ESG. I think a lot of it is just, it's subjective, right? It's often values-based investments or investing, and values are relative or very subjective. I think there's a lot of consensus of problems in the world, but how that manifests into portfolios and whether those investments actually matter, right? Those are different things. And so the subjective definitions and sort of implications may be best handled perhaps even outside a commingled vehicle, right? So instead of ETFs and mutual funds, perhaps this is really where direct indexing is taking shape and having much more impact. And then separately, I think people can go very micro, so passions, right? Very specific sort of charities or very specific causes, instead of very macro at the 3 letters, E, S, or G, but getting very specific. So I think this is clearly a trend that's not going away. It's clearly a generational and increasingly all institutional as well as smaller investors seem to be seeking to impact and think of all stakeholders in their investing. So ESG as a concept continues to grow. I think we're still very, very early innings in sort of defining what ESG really means and giving people the choice to sort of customize and have impact. Our take, again, I think we're exploring more of the passion / sort of very concentrated applications of ESG, very specific causes and things like that in our current lineup as well as in futures, and less so on the sort of institutional size, sort of common standards and things like that, which is, again, a lot of popular strategies out there, and institutions focus on that approach. I think we lost Doug.
Doug likes making an appearance and disappearance. What can I say? But here he is again. I think he's coming back on.
Why don't we just turn this into discussion instead of
Yes,
Q&A
it
until we
is
get
a
to...
discussion anyway. I mean, you are the three experts, so please go ahead.
Paul, the topic that you brought up in relation to more specificity, I find very interesting, and obviously one of the big topics that is undeniably there is climate change, which I think is probably something that also Doug wants to lead us to with his next question.
Unreal. Sorry, tribulations of computer and technology. Arne, I don't know if you got a chance to kick off, but where I wanted to head was to go a little deeper in ESG. And I want to talk about specifically climate change, because I know DWS, you're involved in that space. Could you share a bit of your thoughts about what you're seeing from investors and how they're looking to invest along the, climate change as a purpose?
Yeah, with great pleasure. And this is, and I was saying just as you joined, this is one of the undeniably big topics that for sure has to be on everyone's radar in some way or the other, and squarely falls into that E bucket. So there's different aspects of climate change, of course, that affects us across the investment platform. We look, and particular, my colleagues from our research side have recently published a very interesting report on water risks, which obviously is part of climate change. Our municipal bond team regularly looks at aspects such as flooding risks and risk out of environmental disasters for the municipal bond portfolio. So all of these little aspects, rather significant aspects, not little aspects, but all of these very significant aspects find their way into our investment process across the platform. Specifically, when we look at our ETF offering, we actually recently brought to market a fund that we call Emerging Market Carbon Reduction and Climate Improvers ETF. It's a bit of a mouthful, but we literally, as they say in Britain, wanted to bring something where it does what it says on the tin, meaning we wanted to have a portfolio that essentially is a broad-based emerging market portfolio, but instead of holding the thousands of names that are in the MSCI Emerging Market Index and essentially have swallow, so to speak, the carbon footprint that often does not look great with some of those companies, we've developed a strategy that has a relatively narrow tracking error. When I say relatively narrow tracking error, it still has a tracking error of roughly 150 basis points. So not overly tight, but also not all over the place. And at the same time, seeks to have a carbon reduction footprint of 60% compared to the parent benchmark, as well as ongoing improvements year over year. So really, we wanted to bring to market a tool that allows investors to have a broad-based emerging market fund, but not have the meaningful negative carbon footprint that a traditional index fund portfolio has. That type of strategy so far has proven relatively successful for us. We had institutional client backing for the launch of roughly $500 million. So there is actual, commitment for that type of strategy, which in our view is something that is very, very critical from an investor standpoint, and where from our standpoint, we also would like to see future development, both on the asset owner as well as investor side, as well as from our perspective through the investment asset manager platforms.
Thanks for that. And Gunjan, before we leave the topic, any final thoughts, particularly around maybe climate change?
Yeah. Look, I think I'm coming off of the back of some of the comments that Arne made. I think as I touched upon on the overall theme of ESG, I think we're now at the stage where we've had some first generation products in the market for a number of years, and they've focused on some of the basic exclusions of carbon producers. But with the proliferation of data now, it's really allowed us, I think, as an industry to pursue broader investment mandates. And I think at a headline level, some of the key driving forces on certainly from our side, where we're seeing the investor demand generate from are the regulations, are through some of the policies that are coming into effect. And I think it's no surprise, when we take a look and see where the landscape is globally in terms of the investor appetite, we're really seeing EMEA investors lead the way. So I think that there will be a slightly different rollout in terms of the timelines and investor readiness. But I do think that we will continue to see beta solutions across the marketplace offering access to these exposures as more and more investors begin to use climate as a core exposure in their portfolios.
I'd love to add like one more thought there too.
Yeah.
I think in some way the market, the pure passive approach, right, indexing, seems to be doing an okay job if you think about multiples for green tech companies versus sort of your old industry and energy companies and of that sort. So I'm not sure that the growth of ESG will meaningfully change valuations and the sort of the big picture, but I think either way the market's headed there, and clearly pricing in things like investor preferences and sort of policies and market support. And so remains to be seen how much an ESG specific mandate versus what the market is already doing on its own has a bigger impact.
Yeah, very, very fascinating and fast growing place. So obviously more to come, much more dialogue. Excuse me. For our panelists, I sent all the questions out in case I have another computer issue. You have them in front of you. So for everyone watching, I apologize. But let's keep going. You know, as we're short on time, I want to change topics. Gunjan, if I could stick with you for a moment. You and your team have produced a lot of research around fixed income and the idea of fixed income liquidity and how that marries itself into ETFs when we start to wrap ETFs around fixed income. So I was wondering if you could share some of the research your team has produced and help enlighten the audience in this space.
Yeah, look, Doug, I think, this was really accelerated by, again, some of the data points that we were able to gather through the insights of the COVID volatility and really what happened in fixed income ETF trading in particular. And, very intrigued by what we saw on our side, which was fixed income ETFs be additive towards providing, if you like, a liquidity buffer in some cases where the underlying bonds in and of themselves were not trading or the return of quotes was taking longer than usual on the traditional platforms of dealers. So that for us was hugely fascinating. How far do you go along the curve when you consider the underlying liquidity of a single name instrument, bonds in this case, and how you compare and contrast the liquidity of an ETF made up of a basket of those securities, and where do the two come together? Where can they be helpful? And what is applicable to what type of investor? And when we pulsed out, in particular, institutional investors, for institutional investors in the fixed income ETF landscape, liquidity is a significant driver, is what we have found. Amongst their choice of either ETF or investment vehicle or method of execution, even when you take a look at platforms. So it's of no surprise that we saw heightened volumes going over exchange. That was a data point in the height of COVID volatility that we saw globally as a consistent theme. And then we also saw the increased volumes globally in ETF trading. And again, I think that was a really important data point, both fueled fundamentally, we believe, by the liquidity that the ETF wrapper offers. So I think there's a real pathway and perhaps an opportunity to do a deeper dive in the marriage of fixed income markets and the liquidity that ETF as a wrapper or as a vehicle can actually offer some of the traditional fixed income markets, market structure, landscape, or investors to really dig deeper there. And I'm excited to see what that will bring about in the future.
Thank you. And for those listening in, by the way, all three of these panelists have fantastic websites. I personally spent time on all of them prepping for this panel. So please go do the same. Arne, I want to come back to you because when I was on the DWS website, you've got quite a bit of content around fixed income. There's a lot of news right now about moving interest rates, where the Fed's going. Tell us what your investors now as they're looking at fixed income.
Yeah. So in principle, very much would love to echo Gunjan's comments just now. Whilst traditionally maybe ETFs have been looked at more from sort of through an equity lens, of course, they trade such as stocks on the New York Stock Exchange. They have a bit of an equity look and feel, but that doesn't mean that they're irrelevant for fixed income. It actually means quite the opposite. It means it combines the advantages of equity-like liquidity and fixed income type of exposure. So in the gist of it is very much that no matter, you know, whether we think of ourselves at risk of rising interest rates, or whether you have the position that that risk isn't necessarily imminent, fixed income ETFs most definitely can have a place in people's portfolios. And then it sort of goes back into sort of what client group are we talking about or talking to. So, you know, are we having conversations with an asset allocator whose desire it is to have a broadly diversified portfolio, but they don't really know how to utilize ETFs in the fixed income world? It would be in relation to, in particular, for example, our broad range of, not to sound like a broken horse, but ESG fixed income ETFs, how you can get exposure to standard investment grade corporate bonds, emerging market sovereign bonds, maybe high yield corporate bonds with an ESG angle, and still have sort of those bread and butter type of exposures. Or are we talking with insurance companies who have different type of needs, of course, you know, and then the conversation is around what type of NAIC rating do the funds have? Can the insurance companies receive a look-through treatment into the portfolio? So, and then of course, you know, the execution question becomes relevant, because bond allocators typically are used to, you know, over-the-counter trading. The pricing works a little bit different. To trade something that behaves like a bond but feels like an equity still sometimes is a little bit alien for some of the execution desk. And that's essentially where issuers such as ourselves or Gunjan's team would come in and have the conversation and with the relevant individuals to make sure that, you know, that marriage between an equity-like instrument and a bond exposure is really well understood.
Yeah, it's you know, I love how all these topics are kind of combining together into each one of your businesses. Paul, as we're getting close to closing out on time, fixed income, really interesting take from the Simplified group. You actually have an ETF that that looks at interest rates moves. It's PFIX, listed in the New York Stock Exchange. Can you tell us how that works, and as well as any other comments you might have on the fixed income markets?
Sure. So as I alluded to in an early part of our conversation, really, there's been all sorts of reasons why asset classes are elevated, right, in valuations. And the biggest bubble, according to many, is actually in the fixed income market, right, with literally negative rates in much of the world and near record rates across the US. And so in that world, not only is fixed income risk, i.e. interest rate risk, a meaningful part of your fixed income book, if you really think about it, it's actually an embedded risk inside of all risk assets, particularly growth stocks that have a lot of implicit duration risk in there. And so we think it's really important to think about that risk. We've benefited from 4 decades worth of declining interest rates. What happens to portfolios and risks if interest rates start reversing? And we're seeing inflation, and we're seeing central banks across the globe starting to sort of dial back their stimulus, right? And so I think from that perspective, how do you hedge an interest rate? Some of the best ways to hedge are actually not available to most investors. Some of the deepest interest rate hedges are actually in the OTC derivative space, particularly things around swaps and swaptions. And so this ETF that we offer effectively provides access to ISDA OTC derivatives swaptions that allow very long maturity options to protect against interest rates. Why long maturity? It carries better, so you don't sort of bleed away your option premia. It's also means an investor doesn't have to necessarily get the timing correct immediately, right? If you buy a 5, 6, 7-year option, if rates go up during that time, you have a chance to sort of protect the portfolio versus buying very short-dated and expensive, often high theta, as you call, high decaying options. And that's what we've really packaged, this really effective institutional caliber portfolio of puts on interest rates. So if rates go up, this will really hedge not just that allocation, but the entire portfolio.
Thanks, Paul. And you know, I know we're out of time. Your comments and really everyone's comments bring together what I love so much about the ETF marketplace is that there are ETFs for just about anything you're looking at. And I really invite anyone who's listened in, please go explore the websites between State Street, DWS, Simplify, come to the New York Stock Exchange website, the home of ETFs.com. A lot of educational content out there. Please reach out to any of us. For Paul, Gunjan, Arne, I really appreciate you taking the time, sharing your thoughts with everyone today. We invite your comments, we invite your questions. Thanks for joining us on the panel today.
Thanks, Doug.
Thank you so much.
Well, a big thank you from me as well at the closing of the session. Thank you, Doug, for putting this excellent panel together. And of course, thank you to all of you for joining and making it so special. Thank you very much.
Thank you.
To be continued.